In line with this, mortgage lending picked up slightly, growing at an annual rate of 0.6%. So to conclude, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
So the first question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Thanks for taking my question. My first one would be on the next steps. So it sounds like you expect to reach a 2% target maybe sooner than predicted in September. Does the decision to cut today really represent a shift of gear? Do you expect a cut at every meeting for the next few meetings now to be the most likely scenario? And the second question would be on the US election. So you mentioned trade tensions as a risk, but can you elaborate how you think a return of Donald Trump to the White House and his plan to impose tariffs would alter the outlook for growth and inflation in the euro area?
Well, thank you so much for your question. We decided to cut all our rates by 25 basis points because we believe that the disinflationary process is well on track. And all the information that we received in the last 5 weeks since our last monetary policy decision were heading in the same direction, lower. Whether you looked at inflation numbers, headline, core, whether you looked at PMI numbers, all categories, composite manufacturing, services, employment, heading downwards as well. If we look at all the surveys that are in the works at the moment, of which the specific numbers and data will be available soon, it is the same story. Whether it's a corporate telephone survey or other surveys that we have available, it's all heading in the same direction, downwards. And that really confirmed for us the confidence that we have that the disinflationary process is well on track. That is what has caused us to make the decision to cut our 3 rates by 25 basis points. We have also reiterated that we will continue to be data dependent, and honestly, this decision is a case in point of us being data dependent. We have all the available data, all heading in the same direction. The largest countries all also moving in negative territories in PMI numbers. So those are really strong elements because of their synchronization and the similar direction that we have to take into account those data and make the decision that we have made. But we are going to continue doing exactly the same thing. And it's clear that between this meeting and the next meeting we have in December, we will be receiving more data, some of it soft, some of it hard, and more readings. And all of that will help us decide, as I have said, meeting by meeting, what monetary policy stance we should decide at that time. So I think there was no no variations in that respect from decision that we made in the past in terms of methodology. It's the same steer, the same stance, the three-pronged approach, and the meeting-by-meeting data dependency, no predetermined path. So on the other point that you raised, trade is obviously an important element, and as part of the drivers of activity going forward, we obviously have consumption and investment, but we also have trade. And any restriction, any uncertainty, any obstacles to trade matters for an economy like the European economy, which is very open. Trades within itself, of course, but trades also with the rest of the world. So any hardening of the barriers, the tariffs, the additional obstacles on that possibility to trade with the rest of the world is obviously a downside.
Thank you. Next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you. Thank you. Hi. My first question would be on the economic outlook. So you were now referring and pointing out that the economy really doesn't really look great and all signs point towards more downspin. Why don't you go for a 50 basis point cut? And is that something you have discussed, or whether this is on the table for the next ones? And have you been discussing the topic of the possibility that inflation could also undershoot if you keep your policy stance restrictive? Thank you.
Well, thank you very much for your question. It is a fact that the economic activity has come in on the basis of the element that we have and the indicators that are available, has come in a bit below what we had anticipated. But this is not a projection exercise. We are in between two projection exercises, and clearly December will be another opportunity for us to, run all the data, all the information through our model and to apply the three-prong approach to our stance. What was on the table and what was debated and proposed by our chief economist, Philip Lane, was a 25 basis points cut. End of the story. We had discussions and debates and rationale and narratives and all of that is part of the debate and the legitimate discussions that we have within the Governing Council. But at the end of the day, there was a unanimous decision to cut rates by 25 basis points. It may have been the Slovenian great atmosphere that precipitated this not more than consensus. There was unanimous decision to cut by 25 basis points, and we thought that it was the appropriate decision to make in view of the moment, in view of the indicators that we have, and our assessment of this disinflationary process that is really underway and well on track. That's really what. Risk of undershooting, risk of overshooting, we can debate ad nauseum on this particular matter, and you will find views on both sides of the equation. I think, what is clear to all is that we still have risks on both sides of our forecast, upside and downside, probably a bit more on one than the other, probably more downside risk than upside risk, but I'm talking here about our forecast for inflation, and that's what we are looking at.
And the next question goes to Aude Kerselec of BFM Business. Aude, please.
Bonjour.
Thank you for taking my questions. Inflation is expected to reach a target in the course of next year instead of at the end. Will we reach neutral rate earlier than before? How will you recalibrate monetary policy on cuts to come? And second question, is German economy the main reason for the shift since September, when the today's cut was unlikely, or at least is it a good reason?
First of all, we don't recalibrate, we calibrate. And this is really the process through which we go. As laborious as it is, we believe in our three-pronged approach. I won't bore you with the repetition of it all, but it's inflation outlook, underlying inflation and transmission. And we calibrate our monetary policy on the basis of all the data that is available and applying that three-pronged approach. Now, it's obvious that the state of the economy and the activity has a bearing on inflation. And to that extent, of course, we take that into account in order to assess inflation and its return in a timely manner to our target. But that's the extent of our consideration, the bearing of activity on inflation, because our job is price stability and our mission is to return inflation back to 2% target in the medium term.
Turning to our online participants, the next question goes to Olaf Storbeck of the Financial Times. Olaf, please. Yes, please go ahead. You are unmuted now. I'm sorry, we can't hear you. You seem to be talking, but there's no voice here. We let you sort that out, and then I would go to Jean-Philippe Lacour of AFP. Jean-Philippe, please.
Hello, hello. Can you hear me?
Yep.
Very good.
We can't see you, but we can hear you.
You can hear me?
Yeah, and now we can see you as well.
Okay, very good. Thank you very much. Good afternoon, Madame la Présidente. I have two questions. So you said earlier we will have more data in December, not much more, but more data. And if they all point in the same direction as you outlined earlier as well, so you will just have opened the door widely for a new rate cut in December, if I interpret you well. And the second question, you mentioned the tensions in the Middle East that could feed inflation through the energy prices. What about domestic stimulus in China, which is huge and could also revive pressures on energy prices through domestic demand and then feed the inflation? Is it something that you will combine with those Middle East tensions, look very carefully at in the next months?
Well, thank you very much for your two questions. It is a fact that at each projection exercise, we receive more data, and in particular, more updated projections, of course. And typically, given that between now and the December meeting, there will be more than 6 weeks, we will also receive more data. And as I said, I did not open the door to anything. I repeated that at each and every meeting, we will look at the data, hence we will be data dependent, not data point dependent, nor anything else, data dependent, all of it. We will determine what is the best rate, what is the best speed, how far, how deep we have to go in order to return inflation to its 2% medium-term target. This is what we will do in December, and I would not, give any other commitment, nor make any other statement in that respect. As I said in the monetary policy statement that I read earlier on, we are not pre-committing. And again, I think that the decision that we're making today is a perfect example of how we can be data dependent. You refer to two areas of big concern, one coupled with obviously a major conflict and a horrifying one that is taking place in the Middle East. We, of course, are concerned beyond the humanitarian approach, beyond the conflict aspects. We are looking at the economic consequences. And we are looking in particular at the impact that this conflict could have on trade, because that part of the world is very much open to trade and the passing of ship of all sorts. We are also very attentive to the price of oil that can be impacted. And this oil price is a good segue into your question about China. What will happen in China, what kind of stimulus will be activated with all full details as is expected at some stage, will also be an indication of the demand addressed by China to the oil market and the impact that it will have on the price of such commodity. So we are looking at all those components and obviously focusing on the economic consequences and the impact that it could have on inflation, and obviously activity to the extent that it impacts on inflation. Thank you.
I don't see Olaf Storbeck, but he has perhaps connection problems, so we will return to him later. Balazs Korani of Reuters. Balazs, the floor is yours, please.
Good afternoon, and thank you so much for taking my questions. The first one is about economic growth. President Lagarde, is a soft landing still your main scenario? And am I correct to see that perhaps your attention has shifted slightly from inflation concerns to growth concerns? The second question is about a line in the statement which says the rate is still restrictive. But I'm curious, we thought, restrictive is this unobservable concept because we don't know what the neutral rate is. But perhaps maybe you started having a discussion in the Governing Council on where does restrictive stop? So I'm curious if you have any thoughts about where does restriction end and where does accommodation begin?
Well, thank you so much for your two questions. On the issue of economic growth, are we still on a soft landing expectations? The answer is, on the basis of the information that we have, we certainly do not see a recession. So the euro area, on the basis of what we have, is not heading for recession. And we are still looking at that soft landing that you have just mentioned. Now, you asked me whether we are more concerned about growth than we are about inflation. I would say that we are concerned about growth to the extent that it has an impact on inflation. And we have to be particularly attentive to both, but one, because of the impact that it has on inflation, which is our main focus and our key objective, as you know. So, there is, and you pointed to it, that sentence which is sort of the magic language, and I'm sure that you will be very attentive if and when that magic language changes a bit. We still say we will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim, which refers to the previous sentence, which is we are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. So, there is no question in our mind that we are currently restrictive. Hence that sentence. There is also no question on our mind that we are not yet at this 2% target. I just want to give you the exact wording, to our 2% medium-term target in a timely manner. And this has to be sustainable. So even if it could well be, as markets anticipate, but they are not always right, that the time at which we reach that 2% sustainably has advanced a bit, but it is not yet now, and we will have to wait further in order to make sure that we are at that 2% sustainable medium-term target. Thank you.
Olaf Storbeck of the FT, I see you are back. Floor is yours.
Hello, can you hear me now?
Yes.
Excellent. Yeah, thanks for taking my call, and apologies, kind of double apologies for not being there in person. I would have liked to come, but I couldn't make it.
You would have enjoyed it.
As I'm new to this wonderful world of central banking, I have a probably relatively basic question here, and then another one. In the introductory statement, you referred to this updated assessment of your inflation outlook. Does this refer to the September staff forecast, or has this changed since September within the Governing Council? And if so, could you give us a little bit more color on what the actual change in this inflation outlook has been you're referring to? And my second question is also again to the theme of undershooting the 2% target. I mean, even the September forecast said it's kind of it was projecting at the 1.9% inflationary rate for 2026. I think from the second or third quarter onwards. Has this been changed, and to which degree do you think it already shows that monetary policy is too tight? Thanks.
Well, thank you for your question. If anything, I would say that what the numbers are showing at the moment is that our monetary policy is working. And the fact that we've managed to bring inflation down as we have so far, not to complete victory, but to have brought it down so much is an indication that our monetary policy is actually working. It's not the only thing that is operating in that respect, but it is certainly part of the elements to explain that we have moved from very high inflation numbers to much lower and hopefully soon to target on a sustainable basis. So our assessment of inflation as we stand now is really based on all the numbers that are available, and that leads us to assess and take a view on inflation now and the potential impact going forward. But that will be done on a strict, rigorous, published way when we have our December projection exercise. And you will be obviously not privy because it will be public, but you will be on the receiving end of those very clear updating. But in the meantime, we are not blind to what happens. And when we receive inflation by way of HICP at 1.7%, when we see core at 2.7%, when we see services moving down to 3.9%, and when we look at the 3 months over 3 month services moving significantly from August to September, all of that put together leads us to believe that inflation is definitely on that disinflationary track that I was referring to earlier. Forecast. Again, we had a forecast in September. Between September and December, a lot of data, a lot of numbers, a lot of indicators, a lot of surveys will come into play, will be integrated in the work that we do. And we will have a forecast that will be, by the way, extended to 27, because the December forecast always takes one further year into account. And we shall see. We shall see whether there is a move and in which direction in terms of inflation, in terms of activity. But in between projection exercises, as I said, case in point that data matters. We look at everything that we have available, and if it is appropriate to take us closer to this timely reaching of our target of 2% medium-term symmetric, we make the decision as we have today.
And the next question goes to Miha Jenko of the Slovenian daily Delo. Miha, the floor is yours.
Thank you. I would just follow the previous colleague who asked what happened since the September meeting. And my question is, are you in the ECB somehow surprised by so rapid drop of inflation, enabling you actual rate cut, which wasn't fully expected or priced in the September? Thank you.
That's a really good question, actually. Thank you. Thank you so much. You know, what is a little bit irritating sometimes is the lapse of time between meetings. And on this occasion, there were only 5 weeks. But in those 5 weeks, we received quite a lot of information, some of it by way of hard numbers, readings that were actually updated, actually downwards a little bit today. Some of it by way of PMIs, which are a bit softer than hard data, but all synchronized and moving in the same direction. So were we surprised? I'm not sure that we had anticipated that 1.7, nor did anyone else for that matter. Because if I look at at analysts, if I look at those whose job it is to project as well and to forecast, or markets, I think we were all a little bit surprised by the acceleration that is being demonstrated by that numbers. But it certainly raised our confidence that the disinflationary process is well on track. But having said that, we are data dependent. And that's the beauty of the English language. Data is either singular or plural, but it's the same word. We are not data point dependent. So it's not because inflation came out, HICP, at 1.7 or core at 2.7 that we made that decision. We need an array of information and data. And by the way, we also know, for instance, based on the work that has been done and that was already mentioned during the previous press conference in September on the basis of projection, we know that the next 3 months will not have this linear, low and below target inflation number. We know that it will be higher than that because of obvious base effects that we know of already. And we shouldn't be surprised at that, and we should not be jumping to any kind of conclusions either. Thank you very much.
And the next question goes to Klaus-Rainer Jakisch of HR-ARD, German television.
Good afternoon. Thank you very much for taking my questions. Mrs. President, the first question relates to your statement some months ago when you said and promised the population in the Eurozone to break the neck of inflation. If you look at some of the points which you mentioned, that the fact that inflation is going to rise again, if you look at service sector, at food prices, all the effects which really concern the normal people, would you say that the neck is broken or not? And the second question relates to your interesting speech you held to the Governing Council last night, in which you described the admirable economic development of our host country here. Could you perhaps quickly or briefly summarize again what we actually could learn in other countries from this interesting path here in Slovenia? Thank you.
Thank you so much, and thank you for bringing Slovenia back to the picture, because there is a lot to be learned from Slovenia. So, have we broken the neck of inflation? Not yet. Are we in the process of breaking that neck? Yes. Now, we know, and I was on the market in Ljubljana a couple of days ago to check on prices, because I come to Ljubljana on a regular basis if I can. Food prices are still growing at 2.4% on average in the euro area. And this is not the 2% that we want. We are clearly still above target, and it's one area, together with energy prices, to which consumers are highly sensitive, which has a bearing on what they do, whether they consume, whether they save, which matters a lot. So we are extremely attentive. We know that food prices in particular are very sensitive, and we know that we are not at target yet on that front. But are we breaking the neck of it? Yes, I think so. It's not broken completely yet, but we're getting there. On your second question, I think the key messages that I wanted to make yesterday, using the beautiful example of Slovenia, is that in times of uncertainty, you have two options. You can either resign yourself and suffer, or you can get a grip of yourself and take uncertainty as an opportunity, which is exactly what Slovenia did when it became independent, when it fought inflation, and when it really bounced back in terms of economy. The second lesson, which is interesting, which I mentioned yesterday as well, is that when there is that expansion, when there is prosperity, it needs to be widely shared. And that is particularly the case in times of risk of digital divide. I think it's a very good case in point where digitalization has been widely spread, and where the Gini coefficient of Slovenia is in the top 3 of all the OECD countries. So I think the lessons we can learn is that when it's hard, We have to get a grip of ourselves. We have to push for reform. We have to continue to integrate and innovate. And from our perspective as a central bank, if anything, it should push us in the direction of the capital market union, of banking union, and making sure that capital flows and can actually fuel innovation in Europe. Thank you.
The next question goes to Andres Stumpf of Expansión, the Spanish daily.
Thank you. How important was for the decision and the debate the fact that even with the new rate cut, financial conditions will remain restrictive? And the second question, do recent macroeconomic surprises grant a downward revision on growth in December? Thank you.
October is not December. I cannot tell you today what our December outlook will be and what the projections will say. I think we have to be nimble, we have to be attentive to the data that we get and work on the basis of that. On the issue of being restrictive, I made the point, we are restrictive at the moment at current rate. Even with the 25 basis point cuts, we will continue to be restrictive. And we believe that it is necessary and would have to continue to be so until we are confident that we are reaching the 2% target in the medium term. And that will come in due course, but we are not there yet.
And the next question goes to Spela Mikus of Finance, or Finance, Slovenia Daily.
Hi, thank you. You've mentioned you do not foresee recession for the euro area, but at least from Germany, we are getting some worrying data. Is there still a chance that this may turn so that we might see a recession in the euro area? Thank you.
Well, thank you for your question. Even with one of the member states, however large it is, facing difficult circumstances on the basis of what they themselves are producing, it does not necessarily imply that the whole of the euro area is going to be affected in the same way. And based on the information that we have at the moment, we do not see a recession in the euro area. Now, of course, we will have to be attentive to particular sectors of the economy. And as we stand here in Slovenia, which is a country that participates in the supply chain of the automotive sector in particular, of course, many countries will be paying attention to these sectoral developments. But to your specific question, do we see recession? The answer is no.
And the last question today goes to Fabrizio Goria of the Italian daily Stampa, joining us via video. Fabrizio, please.
Can you hear me?
Yes, very good.
That's perfect. President Lagarde, you talk about fiscal consolidation. Government must steadily reduce deficit and debt and public debt. The IMF said the same thing just a few days ago. What are the market risk in the event of a failure to consolidate? And the second question is about bank consolidation. There's a huge debate in the Eurozone. Do you see the bank consolidation as an opportunity for the area in order to compete more in the global market? Thank you.
Thank you to you two consolidation questions. Look, on fiscal consolidation, we now have a fiscal governance framework that identifies the right equilibrium and balance between fiscal consolidation that is needed in many countries and the necessary investment into growth-enhancing reforms. And I think it is that balancing act which is the virtue and the value of this revised governance framework for fiscal purposes. It's associated with the time frame of 4 or 7 years, depending on the level and degree of reforms that the member states will propose and will implement. So if those railguards are followed and observed by member states, we believe that it's the right environment within which to develop activity, and from our part, while the fiscal authorities will do what they have to do in fiscal terms, while the authorities will have what they have to do in structural reforms, we will do our part by maintaining price stability. But of course, we are interested in what they do, because everyone has to play their part. Now, on your bank consolidation question, I have said that last time around. I think I forgot whether it was you asking me, but our view is that bank mergers, to the extent that it strengthens the banking system, and on the basis of the cost-benefit analysis that the shareholders and the stakeholders conduct, which is not to say that we are directly involved, other than through the supervision authorities that we apply to the requests and applications that are filed with us. It is for them to decide how to progress those projects. And I'm not referring to any particular project, as you know. Thank you.
That brings our press conference to the end. The next press conference is going to be in Frankfurt on the 12th. That was
ECB President Christine Lagarde speaking in Slovenia. Let's bring in Bloomberg's Lizzie Burden, who's on the ground in Ljubljana. And Lizzie, it's interesting, you know, they have hit the target. The inflation numbers fell down below 2% in September. They cut rates, but they're not committing to any kind of path forward because they expect inflation to rise up again. Is that correct?
Exactly. Wouldn't it be lovely if Christine Lagarde would tell us just how fast rates are going to fall? The big question, Matt, in that press conference, asked by Alex Weber of Bloomberg News, is this the new normal? It's the first back-to-back rate cut in over a decade, 13 years, I think. And so we want to know whether we can expect meeting-by-meeting cuts going forward. It's what markets and economists see all the way to March, followed by 2 more cuts to take the key rate to 2% by the end of 2025. Unsurprisingly, Christine Lagarde didn't tell us how fast rates will fall, but she did say the decision shows they're data dependent and that approach is going to continue. She said they cut because the disinflationary process is well on track. And interestingly, there was no discussion of a half-point move today, and the decision was unanimous. Look, what matters for the market is she emphasised the downside risks to inflation more than the upside risks. She doesn't see a recession in the Eurozone, however bad things are in Germany, but it's this emphasis on the downside that is why euro-dollar is down, as well as those strong US retail sales numbers. And you've got traders pricing in a bit more easing from the ECB. So a dovish cut overall from Slovenia.
And Lizzie, also in that first question, of course, was a question about Donald Trump and how it would affect ECB forward policy, of course, if Donald Trump was reelected. And I didn't get the sense that Christine Lagarde wanted to talk about American politics.
I don't think so either. Look, she is emphasising that the risks are heightened. She actually said this in a dinner last night, not just from the US election, but also from the geopolitics around the Middle East. But her message on Donald Trump is any more trade friction, any higher trade barriers, and it's something that the ECB is definitely going to have to consider when it comes to the inflation outlook.
Lizzie, thank you so very much for all of your time and all of your reporting. That is Bloomberg's Lizzie Burden. And don't miss a sit-down interview with the ECB's Christine Lagarde and Bloomberg's Francine Lacroix next Tuesday at 10 a.m. Eastern. Katie.
All right, let's take a look at these markets. Of course, U.S. markets opened about 8 minutes ago, and already we're at an intraday record on the S&P 500 right now. If we show that, of course, you will see green on the screen. There you go. The S&P 500 up about 0.2%. The NASDAQ 100, an interesting one. Big tech leading the way higher right now, currently up about 0.4%. Small caps, they have been your winner over the past 2 days, but giving up the lead right now. The Russell 2000 down about 0.2% on that small cap index. Meanwhile, let's take a look under the hood right now and take a look at Uber and Expedia. This is fascinating. The FT reporting that Uber approached Expedia about a potential $20 billion buyout as it looks to expand its travel business. Of course, the FT also reporting that discussions are no longer happening, and you can see the fallout in shares right now. Uber down about 0.2%, and Expedia currently higher by about 4%, Sonali.
Absolutely fascinating report. We're also going to keep an eye here on Blackstone because it posted an increase increase in third quarter profit, and its credit arm became the biggest business by assets. Blackstone just soaring, up 6.5%. It held a total of $1.1 trillion of assets by the end of the quarter. We're going to bring you my interview with COO John Gray in just a few moments. And guys, that firmly brings Blackstone's market cap above Morgan Stanley's, Goldman Sachs's, Blackstone's, and Citigroup.
BlackRock's.
BlackRock, right. Oh,
Yeah.
gosh, I did that
Their
to
market
myself.
cap is exactly the same as their market cap.
No, they're both black
They came from the
rocks.
same place.
TSMC's profit grew 54% to $10.1 billion in the latest quarter. That beat estimates, but most importantly, it raised guidance again and now expects full-year revenue to rise by almost 30%. It just raised that guidance in July. Let's take a closer look at the semiconductor outlook. Bloomberg's Abigail Doolittle. Abby?
And apparently, Matt, a rising tide helps all boats. Take a look at the chip complex right here as that report from Taiwan Semiconductor, the outperformer there, up 9.1%, really helping out the entire space on that big earnings beat, plus the guide. In addition, there was color from the CEO, C.C. Wee, talking about the AI demand and that it's just the beginning, that it's real and it's just the beginning. So investors liking this message a lot. Relative to the guide, let's dig in just a little bit more because it is significant now for the year relative to revenues. They are looking for $26.5 billion versus 24.9%. That's 30% growth on a year-over-year basis versus the 20% growth. You can see the gross margin better and the operating margin a good 300 bips than what investors had previously been expecting. Not surprisingly, if we put TSMC, the ADR, into the context of some of the other chip companies along with the stocks, we're going to see big outperformance here. In white, there is TSMC on the year, up a very healthy 78%. The stocks itself is up 28%. And then if we take a look at Samsung along with Intel, the real difficult one here in the U.S., down 53%. You can see that TSMC, those shares, that stock, that ADR really being rewarded for a great performance and a good outlook, Katie.
All right, Abigail Doolittle, thank you so much. Of course, the chips have been absolutely fascinating. It seems like as for right now, things feel okay.
I mean, yeah, but yesterday they were horrendous.
That was yesterday, though,
Yeah,
and then we had TSMC. Now we feel better.
I think, you know, it's so interesting that we learned again in the case of ASML that there are different kinds of chip makers, right?
Mm-hmm.
AI is very different from companies that make chips for cars.
Yes.
And we don't really get an indication of how things are going so well at TSMC. It seems to be all the AI side and not the side that's disappointment to ASML.
Well, also the geographic footprint here and the way investors are perceiving things at this valuation. I've got to say, you look at TSMC, it's up more than 9% today, but anything else you go to is is up only 3% or more. So that gain is super outsized just on the day, but you are seeing that flow through almost the entire sector minus ASML.
Yeah, it's a good point. We've learned about geography, we've learned about actual functions, and we've learned about the entire supply chain of the chip-making process just in the past week. Let's keep the conversation going with Alessio DeLongis. He is head of investments over at Invesco Solutions. And Alessio, it's interesting. You think about just this week, we are fresh off that ECB meeting. Of course, all eyes continue to be on the Fed. But then you have idiosyncratic company issues, such as what happened at ASML, taking down the entire market. And when you take a look at the balance of risks here, do you think that it's macro that's in the driving seat right now, or is it going to be the earnings picture?
That's really a pivotal moment, right? We have been of the belief that since the payroll report released on August 1st, for the last 3 months, we came back to a macro-driven market. What do we mean by that? A market really driven by the payroll reports, a focus on growth, and that was also validated by Chair Powell's Jackson Hole speech, right? That negated the prior 18 months where the market was driven predominantly by thematic approach, AI, and then to your point, it became really an idiosyncratic market. For the last 3 months, we believe we've been in that macro-driven market. Days like today, days like this week, as you mentioned, throw a bit of a challenge into that thesis, but let's wait for the next payroll report. In my mind, the key message here, both the Fed and the ECB said inflation is no longer a concern. We are going to target, and that is a perfect setup for a macro market driven by jobs, job growth and growth.
At the same time, you know, inflation in the U.S. is still well above the target, right? I mean, if you take a target at 2% and you look at the core, which is like 3.2, it's still sizably above it, whereas the ECB has come below 2%. And even though Lagarde is being cagey about how quickly she's going to get rates way down to far below what our terminal rate is, if you look at a euro chart, Alessio, it's just lost a ton of ground over the past couple of weeks. Do you expect that euro to continue its precipitous fall against the dollar?
The euro has lost ground in the last few weeks, but if you were to enlarge this chart to the last 2 years, you've basically seen a very predictable range between 106 and 112, which also matches basically this path of relative monetary policy where they're just in lockstep. When you take, to answer your question, euro to weaken a little bit more from here, we remain overweight the dollar, and it's mostly due to still the ongoing outperformance of the US economy relative to the Eurozone or emerging markets, which obviously tend to benefit the euro. But do we expect to break that range and past the 106 floor that we've seen for the last 2 years? I doubt it. It's very difficult. Why? You project policy forward, I think you guys mentioned it earlier, out to September 2025 and December 2025, the expected change in yields is precisely identical between the US, the ECB, and the Bank of England, right? So we are in an environment, this is a perfect environment for policymaking, for monetary policymaking, where the FX rate is actually in a relatively low volatility range.
What about the spillover effects? Clearly, through the questioning that you saw Christine Lagarde getting at the ECB today, people are worried about a softening of the European economy, and there were questions about why not 50 as well. If the European economy weakens meaningfully, what can you expect in the spillover to equities, both European and U.S., given that you do have some crossover?
I do think that that is the tail risk. In my mind, the repricing yields that we saw in the last few weeks that took, for example, treasuries from 360 to 410, markets tend to lead the developments in the data. So this good patch of economic data that we've seen, I would say, was largely discounted by the equity rally and the bond sell-off. The risks in my mind now going to the US election, going to the next payroll report is for some marginal downside risk. You're absolutely right. The economic data is still very weak, and that's why the ECB is in a bit of a difficult position. The data are still suggesting well below trend growth, but they don't want to re-engineer an inflation positive surprise. All central banks have been really shocked by the inflation surprise of the last few years. That's why policy is still restrictive, but on its way down. I think you're absolutely right. If there is a negative surprise on growth, that will accelerate the path of rate cuts by the ECB.
Alessio, thanks so much for joining us. Alessio DeLongis there of Invesco Solutions, talking to us about these markets and central banks. We want to give you a bit of breaking news on the conflict, the war in Gaza right now. Israel has said that it may have killed the Hamas leader Yahya Sinwar, part of a renewed assault against the militant group after more than a year of its war in the Palestinian territory. It is not confirmed. Israel's IDF said they are checking the possibility that Sinwar was one of the 3 people killed. We know from CNN that they're using DNA testing, and we have heard reported by N12 in Israel that that testing has confirmed the death of Yahya Sinwar, but we haven't heard from Israel or from Hamas the official confirmation yet.
It would certainly be a large moment in this conflict. We'll bring you updates as we get them. We're going to switch gears. Coming up next, we're going to talk about Blackstone, the credit arm becoming the top business at the firm, just fueling those third quarter profits. We're going to bring you part of my conversation with Blackstone's Jonathan Gray next in today's Wall Street Beat. This is Bloomberg. One stock we're watching this morning, Blackstone. Shares hitting record highs today. The stock is on a tear. The investment giant posted a jump in third quarter profit boosted by its credit arm. And this morning, I spoke with the company's president and chief operating officer, John Gray.
We clearly have been in a really great period for credit, right? You had spreads that were quite elevated. You had base rates elevated, and both of those are normalizing. So there's some excess return that's obviously going to come out of the system. But the real question is, can private credit deliver a durable premium over liquid fixed income? And to me, the answer to that is yes. And that's because of the farm to table model, the ability to bring investors right up to borrowers and give that holistic experience and deliver a higher return to those investors. And so you look at what we're doing in private investment grade credit, primarily for insurers today. And on average, we've delivered 185 basis points of higher returns on A-rated credits. And to those insurers, they say, wow, that's really attractive. That's why you see our insurance area growing 24% year on year to $221 billion. And in credit overall, this $432 billion between corporate and real estate credit. So it's an area that has a lot of momentum. And I think secularly, you'll see big investors around the world continue to allocate not only to non-investment grade credit, but to this investment grade area also in the private space.
I also want to turn here to private equity for a moment because we have a market that's been waiting for a faster pace of realizations. Wondering what your expectation is here for sales to pick up and the IPO market to open up at scale.
Well, look, realizations have been the one thing that's lagged, but we have a lot of optimism when we look out to 2025. And if you were sort of, drafting a recipe to think about realizations, you'd say, well, I'd love to see base rates come down. And we've seen both short rates come down. I think they'll come down further. We've seen the 10-year come down. You'd say, I'd love to see spreads tighten. And we've seen 100, 200 basis points of spread tightening in corporate and real estate. You'd love to see more liquidity in the market. Banks, clearly, you talked to a bunch of them this week, are becoming more aggressive in lending money. The commercial mortgage-backed securities market is up fourfold in volume this year, so more liquidity. You'd like to see a strong equity market, record highs this week. And then, of course, you'd love to see more IPOs, and that's been lagging. But when we look out, we see a pipeline that's picking up momentum. If you talk to the banks, their pipeline of large IPOs is double where it was 6, 12 months ago, and we're having real-time discussions on IPOs. They've gone from sort of the theoretical to the practical. Should we do this in February or April? And it's natural because as equity markets go up, it's like a magnet pulling companies into the public market. So I think we're starting to lay the foundation for a much better realization period. It will happen. It takes time. You tend to plant seeds first and then harvest, but we're starting to move in that direction.
Can you give us a sense of how big 2025 might be for a year? A lot of people across the street talking about that pent-up demand from firms to start to exit companies. Does that mean 2025 will be the best year since when? How many companies do you maybe have in your pipeline? What kind of scale are we looking at?
It's hard to put a number on things. The key for our business is we've obviously focused on maximizing returns. So if market conditions aren't there, we'll be patient. But it's really about a path of travel. We saw M&A volumes fall 50, 60%, even more in the private equity space. Now, as I discussed, the conditions have improved. And I would expect a meaningful pickup next year in activity. And that's just the way things are. It can, ramp up over time. It's obviously a function of markets, but the direction of travel is there, and certainly debt costs coming down. If you look at borrowing costs to do a private equity deal, so to sell to another sponsor, probably costs 300 basis points less than it did at the height. Or if you were talking about doing a real estate deal, it could be as much as 300 or 400 basis points lower. So I would just say overall, it feels like it'll be a meaningfully better environment next year, but hard to put an exact number on it.
That was Blackstone's John Gray. And as we've been talking about, guys, a few things that are notable. The market cap of Blackstone is surpassing $200 billion for the first time. And I remember back in 2021, I wrote when it surpassed $100 billion. It's doubled since then, and it has surpassed, at that point, just Goldman Sachs, now multiple banks.
I liked when he asked himself the question, can private credit deliver a durable premium over liquid fixed income? Can you imagine if he said no? That would have been amazing.
Well, if you're Mark Rowan, you think that the public and private are going to converge. And to your point here, at what point do returns also converge?
Yeah.
By the way, the market cap of BlackRock which manages $11.5 trillion in assets, is 25% less than that of Blackstone.
That only manages one, and just incredible, Matt.
Yeah, absolutely. Coming up in the next hour, we're going to continue our conversation with high-powered finance people. Vlad Tenev joins us, the CEO and co-founder of Robinhood. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a golden era for retail traders. Robinhood CEO Vlad Tenev unveils the company's latest products from the Hood Summit.
Volatility coming for U.S. stocks. A conversation with the Cboe Global Markets CEO on how thrill-seeking traders are set to cash in.
And 19 days and counting until the U.S. presidential election. Both Donald Trump and Kamala Harris trying to court demographics they've been struggling to attract. We'll have the latest, but let's get a check on these markets. 30 minutes into the U.S. trading day. You take a look right now. We do have a rally on our hands. The S&P 500 at an intraday record. Of course, we got retail sales this morning coming in hotter than expected. That's giving a lift to markets, as too are the chip names. And you're seeing that reflected in the NASDAQ 100, currently higher by about 0.5%. And those retail sales, of course, impacting the bond market right now, boosting yields by 7 basis points. That 10-year Treasury yield now trading at 408, Matt.
All right, joining us to talk about markets and the economy is Katrina Dudley, Franklin Templeton Public Markets Senior Investment Strategist. She says October will be bumpy, and of course we have a pretty important election coming up, so I guess you could expect volatility, but from here on out, aren't we good to go? The economy's on fire, the Fed is cutting, everything looks rosy.
Yeah, but September was actually a really good month for us.
Yeah.
And you think about what happened in September, it's surprising that we actually had such a good month. We had, the transition of presidential candidates. We had an assassination attempt on a presidential candidate. We had a lot of noise around the election, yet the market continued to outperform, given this strong performance from some of those AI stocks.
And let's talk a little bit about that. This is something I asked Alessio DeLongis, but again, we've just been watching the chips really inject volatility into the broader markets all week, of course, emanating from ASML and then into TSMC. Yep. Currently, volatility to the upside, but how are you weighing the macroeconomic forces and the central bank decisions versus, of course, the earnings season that we're heading into?
So there's a great lot of things to unpack there, and I think that that's what is driving this market, is that there's so much to look into and to notice and to analyze, and that for me is a really good sign of a healthy market. So the first thing is on the macroeconomic side. You talked about the election, and one of the key things that our electorate is coming back to us is saying the economy. The economy isn't great, but then you have a data point like retail sales, and retail sales comes in very strong. You look at inflation. Inflation is a big concern on the minds of a lot of people, but actually our inflation numbers are coming in closer to target. So there's a lot of good things, but the mind of the consumer really doesn't match what the data is telling us. And I think that that's what we've got to overcome, and that's the concern going into the election.
What's the read-through to the equity market? I think that's a really interesting observation, because if you look at the last month, you don't see consumer discretionary really leading the way it had been the month prior. Are people starting to lose a little faith in the U.S. consumer?
I think that they were concerned about the soft landing. They were also concerned ahead of the election, causing that kind of pause in spending. You also have a look at some of the big drivers of spending as things like a car. And now if you look at the cost of a car and how much of that it actually takes, it's an additional 2 weeks for you to be able to afford a car. If you look at a down payment on a house, it's now 19 years of regular savings to be able to afford a down payment on a median house. So some of these things are what are reflected in the concern of the consumer, and I think that that's why the consumer stocks haven't really been outperforming. The other fact is that one of the hidden secrets of retail sales is that the higher end consumer is actually a bigger kind of driver of a lot of those retail sales than some of the middle and lower, just in terms of the percentage. So you can have a very healthy upper end consumer driven by strong gains in asset values in the stock market. They're going to spend and show up. So we do need to continue continue to focus on that middle and low-end consumer.
In terms of earnings, we're only expecting it depends who you ask, but 4.2% earnings growth this quarter. That's because I guess the third quarter last year was the pinnacle of earnings for S&P companies, but it's only 0.1% gain sequentially. So isn't it a very low bar? Aren't we going to blow away earnings expectations again this year, or this quarter, I should say?
We're seeing a lot of mixed signaling. Have a look what's happening in some of the Medicaid names. For example, Elevance this morning. Their earnings are suffering because of things actually related to COVID. So I mean, we're going back and we've got the ramifications of what was happening in terms of trimming the Medicaid rolls, which has happened more recently, people going back to the doctors, and that is actually impacting their earnings today and causing some pressure on those numbers. You're offsetting that by some of those other names, like some of the tech stocks and the AI-driven stocks. So, really that 4%, though, let's just, lift it right up to the high level. For an economy like the United States, posting 4% growth in earnings, to me, is phenomenal. I mean, we're a big economy, and 4% to me is kind of in line with GDP growth.
I hear 4%, and we're talking about earnings, but I also think about cash as well, since cash yields are hovering between 4 and 5% right now. And as we see time and time again, we get those weekly numbers on assets in money market funds, and they're just stuck above $6 trillion. It just seems like that asset base that is gathered over the past few years is incredibly sticky. What is it finally going to take to see that money come off the sidelines?
I think it needs some confidence. So we actually need to know who's running the country, I should say. We need some confidence in terms of the job market to get that money. And then we need opportunity. So we need places for people to invest. And I think, we've talked about some of the places that we're seeing incremental opportunity for, the investors to allocate capital. And that's coming in the alternative space, in the private capital space. So I think that's what it's going to take to get that money off the sideline is actual opportunity. And I think when we look at some of those opportunities, they take a lot more digging and a little more hard work, which is why you're seeing the delay.
I mean, I say this every time, but I love to look at money market funds, MMFA index go. And if you pull it out to longer term, right, you don't really see that line come down.
No.
I mean, it's only in times of horror that it changes, right? It just continues to rise
Well, if we can show
and rise.
it, what I find really fascinating is that it really jumped up in March 2020, to your point, but then also again when we got those banking crises in March 2023. So I also wonder how much of that is just coming out of deposits.
Well, I also wonder, to that end, if you have to wait for something bad to happen for this money to move, then
Here's the chart. See, Katrina, I mean, yes, it moved a lot in COVID.
It's only 5 years.
People are in gold.
That's only 5
people
years.
Are in money
if you bring it
markets.
out longer, you'll see it doesn't really dip except for the housing crisis and like the bubble burst of '99.
But it's telling you that we're building bigger buffers. We're building bigger security blankets because we're not trusting that there's going to be that security blanket there for us. But also, I hate to tell you, but part of the growth in that is just the fact that dollar-wise, I need a bigger balance to protect my assets and protect my expenditures because my expenses are going up. The way I look at that money market, you should. I mean, look, I go back to my CFP days. When I was studying for that, you should at least have 6 months as an emergency fund, and that 6 months emergency expenses goes up every year. So we have to almost get like an expense-adjusted rate, and I'd love to see something like that so that we could actually analyze
That's a great point.
what people are holding as reserve, because that's the key.
Not just people, companies also, right? Because a lot of this is companies holding that kind of cash as well.
But the companies are actually starting to channel that cash away from buybacks and into CapEx, and that's actually a very good sign for the economy.
Nothing warmer, Matt, than a safety trade. Katrina, thank you so very much. That is Katrina Dudley of Franklin Templeton. And coming up next, we're going to head over to Miami, where Robinhood just announced a host of new features, including futures trading. Robinhood's chairman and CEO, Vlad Tenev, is next. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Israel is saying An operation in Gaza may have killed Hamas leader Yahya Sinwar as part of a renewed assault against the militant group after over a year of war. The IDF is saying it's checking the possibility that Sinwar was one of 3 people killed at a location. It didn't specify the location. We'll bring you confirmation as soon as we receive it, but Israeli media is saying they have it. Billionaire investor Stanley Druckenmiller says markets are pricing in another Trump presidency. He told Sonali yesterday exclusively that he won't be backing the Republican contender or his Democratic rival Kamala Harris.
And I must say, in the last 12 days, the market and the inside of the market is very convinced Trump is going to win. You can see it in the bank stocks, you can see it in crypto. I would have to guess Trump is the favorite to win the election now, but who knows what these polls even mean? No one even responds to them anymore.
It's an excellent interview. You can go back and watch that on Bloomberg.com, on your terminal, or on YouTube. Despite a solid earnings season for the biggest U.S. banks, McKinsey warns that the best times may be over. In its annual State of the Industry report, the consultants say the improvements in returns could be fleeting, and that the recent profitability could only be maintained if banks cut costs at 5 times their usual annual rate. And finally, most importantly, Ferrari has unveiled its first new supercar in more than a decade. It's a nearly $4 million car that's a futuristic twist on a famous 1980s design. The new F80 with a 1,200 horsepower V6 hybrid engine is one of the Italian luxury manufacturer's most expensive models ever. Only 799 of them will be made. Deliveries of the car will start before the end of next year, and it is probably already sold out. Sonali?
And Matt, now we're going to head to that Hood Summit because Robinhood's first ever consumer-focused summit here is underway in Miami. The retail brokerage announced a host of new features, including futures trading and index options. And joining us from Miami is Robinhood Chairman and CEO Vlad Tenev. You know, I understand that you have hundreds of people there and another 2 million people nearly viewing online on your live stream. You are looking to expand your product suite for new customers. I want to point back to just a day ago, Vlad, also. I spoke to Morgan Stanley CEO Ted Pick. He competes with you through their E-Trade business. He said the retail trader is really what's driving this next leg of the market. I'm wondering if you can give me a sense of just how much.
Yeah, well, we've seen definitely retail engagement higher than at levels you would expect given the high interest rates. So interest rates have been elevated, but coming down. But I think what we're seeing is a lot of optimism from the retail community. I mean, we have 800 of our most active customers with us in the conference. And as I was going around and talking to a large portion of them, conversation kept coming back to artificial intelligence, electric vehicles, areas that, you know, the American economy is very much leading. And I think that's been a source of all this optimism. Of course, there's been all sorts of problems in the world, geopolitical and otherwise, but I don't think you can deny that in growth sectors like artificial intelligence, financial services, electric vehicles, and renewable energy, America continues to lead. And I think that's the source of the optimism that we've been seeing.
It's interesting, you're launching these new products around futures and index options. I'm wondering, when you come down to the retail trader, how much more interest is there from them for these derivative products versus plain vanilla spot trading equities?
I think for a certain type of customer that is much more advanced and sophisticated, these products fill a need. So for example, index options, when we talk to our most experienced investors, they like the fact that they can take a position on an entire market and a sector. And they like the fact that since these products are cash settled, they can hold them comfortably up until the market close without having to worry about sellouts and other things like that. And for futures, if you remember the 2016 election,
the market really moved quite a bit, and futures was basically the only product that was trading at that time. Went from 6% down to 1% up. And for customers that want to hedge their risk and trade metals and currencies and broad indices, futures are a great value proposition.
And yeah, of course, it's interesting to see this launch with 19 days to go until the U.S. presidential election, and that context as to what happened in 2016 is nice as well. I want to talk and broaden out and talk about Robinhood's business a little bit more, because you're known for running ads, running promos to sort of poach customers from other brokerages. Do you have any metrics that you can share with us about whether or not you've been successful in that endeavor?
Yeah, I mean, I have to be careful about things that are more recent since we are in the quiet period. But in the last earnings call, we did talk about how for 3 quarters in a row, we've been seeing net inflows from all of the incumbent brokers. And actually, as part of the Hood Summit, we announced that we've got multiple of our offers coming simultaneously as part of what we call Hood Week. So that's 1% transfers on brokerage accounts, 2% for customers bringing a margin balance of above 10,000, and 3% for gold customers bringing in retirement accounts. And I think one of the reasons these have resonated is they're uncapped. So you can basically bring in any amount of money, and we would match you these significant amounts on that. So we've even had customers that are pretty close to retirement age, and they have large retirement accounts, and they're bringing their portfolios over to us because the value proposition of getting that 3% instantly is so strong. So we've seen even older customers than what you might consider sort of like a typical Robinhood customer coming in to take advantage of the new tools and the new capabilities that we offer.
I want to talk about maybe an atypical Robinhood customer. I'm not sure. You talk about active traders, and I know you have 2 million people logged into your event. You have a new platform for legendary trading, so very active, I'm guessing, and you've got a desktop platform as well. But do you work at all with institutional or, say, RIAs? Do you license out your technology to other platforms to use?
We've been getting a lot of requests for that, actually, because the things that we've rolled out for retail consumers over the past year, you can imagine that they're very interesting for institutions as well. For example, we have 24-hour market, which allows we became the first retail broker in the U.S. to offer 24-hour trading of single name stocks. Now that's expanded to over 1,000 names, including some of the most popular ones. We have the lowest margin rates in the industry. So these are things that are very useful to retail, but you can imagine, if you're a hedge fund or other institution or a business, you want access to the markets, that's useful to you as well. And if you are a registered investment advisor, as you mentioned, thus far, the focus has been purely on retail. We want to make sure that we're as focused as possible, and we do, frankly, as good of a job as we can on a limited set of things. But I think over time, that's a natural expansion opportunity for us. Institutions care just as much about access to markets and having the lowest possible rates and the best economics.
Vlad, I'm also curious about something you mentioned earlier, this kind of interest in the U.S. election cycle. Certainly, we have seen a lot of single-name trades headed up to that election. We have seen DJT whipsaw quite meaningfully along with other Trump trades in recent days. How are users on your platform trading the election by and large, and how are they reflecting it through the options market, including the spot market?
Yeah, I mean, I think one of the interesting developments, and this does have to do with futures as well, is the introduction of prediction markets and presidential election contracts that is a recent thing. And I think what customers are really showing is that they need more accurate information. And they're turning to some of these alternative sources, not just as a mechanism to trade and hedge risk, but just as a way to kind of get away from the cloudiness and murkiness of these polls. I think polls have lost a lot of their power and credibility over the past few years. And, you know, some of these alternative markets, people are putting real money on the line. And I think the signal for that is very strong and powerful.
All right, Vlad, we got to leave it there. Really appreciate you taking time. That is Robinhood CEO Vlad Tenev joining us from Miami. Now, still ahead, Pepsi is taking the air out of your half-empty bag of chips. Details next in Social Climbers. This is Bloomberg. All right, it's time now for Social Climbers. Companies making waves this morning. And first up, Airbnb launching a new section of its app where homeowners can hire fellow hosts to manage their rentals. The move is part of a broader push to increase listings and attract more people to the platform. Next up, the most expensive place on Earth just got a little more pricey. Walt Disney announcing a new top-tier park pass that lets some visitors skip the long waits at individual rides for one day. The Lightning Lane Premier Pass will be available later this month for up to $400 a day per person. And finally, PepsiCo is trying to win back snackers by battling shrinkflation. The food giant says that bonus bags of Tostitos and Ruffles will contain 20% more potato chips in some retail locations. Really interesting macroeconomic indicator there. I'm not super sure what it means. But in any case, the CEO of PepsiCo said that the company is trying to take advantage of football season, a time when fans tend to consume more snacks. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, let's get a check on these markets right now. Of course, we had hot retail sales this morning, and you're seeing that in the S&P 500, currently up to the tune of about 0.3%. Big tech is your leader, up about 0.6% on the NASDAQ 100. Of course, we got those chip stocks up a little bit higher today.
Not
the
potato
bond
chip
market,
stocks.
not potato chip stocks. The bond market selling off. Now, coming up, we head back to the Hood Summit in Miami. We'll be speaking to the CEO of Cboe Global Markets next. This is Bloomberg. Well, the options trading surge has just exploded since the pandemic. And in the third quarter, the Cboe's index option suite hit all-time high trading volumes. Let's head back to the Hood Summit now in Miami. I'm pleased to say we're joined now by Fred Tomczyk. He is the CEO of Cboe Global Markets. And we were just talking about this, of course, with Vlad Tenev, that the exchange will soon launch Cboe's flagship index options on Robinhood's platform. We're talking about the S&P 500 VIX, for example. We talked a bit with Vlad about what it means for Robinhood, but tell us what it means for Cboe and the type of investor that you're trying to court here.
Well, we obviously see the growth of the retail investor and the adoption of options going on. It's not just in the U.S., but around the world. And index options are different than single stock options. In fact, they're European style versus American style, and they're cash settled, and you can get favorable tax treatment. So it's been important for us to get index options onto Robinhood's platform. You know, it's a popular platform. It's growing. And when you look at what they launched yesterday afternoon, last evening, in terms of the Robinhood Legend platform, I think they're well primed for growth, and it'll be useful growth to Cboe.
I wonder about the popularity of something else, which is private markets. We hear Sonali talk about this with her guests constantly, and I'm talking to platform operators who want to bring even private markets to retail public. How are you looking into private markets?
Well, we've certainly noticed that trend, and I think it's a good question in terms of what's happening between the public markets and the private markets. There's clearly, because of all the various regulations and increased regulation in the public markets, that's driving some of it, but it's also people have seen the returns that private markets have returned to their investors over the years. So it's growing. We're trying to look at it in a way that, you know, as an exchange holding company, how do we play in that? And that's likely in sort of the market infrastructure side. but it's not going to have the kind of trading volume you see in the private markets.
You know, it's interesting.
Or the public markets.
One thing that has seen interesting volumes this year is, of course, the VIX. And it's interesting. I'm wondering how you are trying to take advantage here of public market volatility. I know you've recently come out with new products around VIX futures as well. What does this all bring you at the end of the day? And how far can the derivative products go?
Well, the derivative products have been growing for 50 years. And so, and growing rapidly in the last 4 years, and you've really seen option volumes go and that complex. We also saw increased demand for access to the U.S. markets. We now have a global exchange platform, all on one technology platform, and we're continuing to see people wanting access to the U.S. market and the use of derivatives, and the SPX complex is very popular for that. This year, between the geopolitical tensions with 2 wars going on and a U.S. election, a pivoting Fed, in terms of changing their perspective, you've seen volatility spike, and you're now seeing the VIX levels up around 2021, which is their long-term historical average. What's been abnormal is the last 3 or 4 years when the VIX has been in the low teens. But we continue to try to build our platform that people can trade and take positions and views through any market, and VIX is an important part of that.
Well, it's a good point, too, that we're just back to long-term averages on the VIX, but certainly relative to the past couple of years, it feels volatile out there. And let's wrap that conversation into the U.S. election. Of course, we are 19 days away, and there's a possibility, of course, that it drags out for a couple days, that we don't know exactly who is president for a while. Big potential here for market volatility. Are you allocating specific resources ahead of this?
Well, we have some of the products we've introduced more recently, where specifically we wanted to get them out before the election to make sure people could sort of hedge their risk or place, speculative views on where they think things are going. But we're pretty much done that. We're now kind of locked down and just organized on operating effectively through these more volatile markets as the election comes in here.
Fred, what kind of early uptake do you have? To the extent that you launch these products right before the election, people are expecting a lot of volatility. You now not only have the VIX, but you have VIX futures, among other things. Can you give us a sense of how much people are trading?
Well, you can see it in our third quarter results where we have record volumes, as you led off with. So you're seeing that leading up to the election. The reason for the futures, the VIX, is it allows people that are not regulated by the SEC that can also participate in the VIX suite of products. And so I think, that's all just, leading us up into this. I do expect it to be volatile. Historically, elections have always been volatile. And we have one of those races where it's not a foregone conclusion, it's a virtual tie. So it could swing either way. So people that want to hedge risk or take advantage of it and take a view, there's more likelihood because the event is nobody knows exactly how it's going to turn out.
So it's uncertain as to who the successor to President Biden will be. I wonder who your successor will be and how that plan has come along. You were named CEO last year as an immediate replacement to your predecessor. How much longer do you plan on steering the ship at Cboe? And do you have your eye on a potential replacement?
Well, obviously, when I came in, I wanted to stabilize the organization because we went through a lot of change back then. There was a fair bit of transition, not just at the CEO level, but at other levels. So we lost 4 of our top 8 executives. So we've accomplished that goal. The company's stable, it's doing well. We also did a review of our strategy and what we're trying to do. I think we have alignment between the board and management on that now. We're executing on that. We've started to lay some of that out into the market, and we'll continue to do so going forward. With respect to succession, I'm not in a rush, but obviously at my age in my life, this is not a long-term thing for me. So we'll do this. I always want to make sure it's done in the proper way and in an orderly way over time. But I don't have anybody in mind right now. We're basically working through that at the board level right now.
All right, appreciate the context there, Fred. And it's been just over a year, of course, since you took over the top job. And we've seen Cboe not be particularly acquisitive in that time. And I think that's interesting because you take a look at your resume, of course. Previously, you were the CEO of TD Ameritrade, where you oversaw this Think and Swim acquisition. And it's only been a year, of course, that you've been in the CEO role. But do you have plans to do any deals here or any appetite?
Well, we do have appetite. What we've done is we did a lot of transactions over the previous 3 years before I started. And it wasn't clear, I think the street's message to us was it wasn't clear what they were doing for Cboe and what was and it wasn't making a difference. And so we allocated a fair bit of capital to that. So we pulled that in. On top of that, the organization was spending a lot of its time on migrations and integrations, particularly in the technology space. And I wanted that to slow down so that we could basically get back focused on organic growth. In my view, M&A can't be your strategy. It can supplement a strategy, but it can't be the strategy. You have to have a solid organic growth strategy. And that's what we've been focused on the last year. With respect to looking forward, our balance sheet's in good shape. Our leverage ratios are low. Our stock's in a good position. So we're in a good position to make M&A happen. But we just haven't found the right target at the right price where it makes strategic and financial sense for us just yet.
Fred, give me the ingredients here. To the extent that you do have appetite for M&A, what are the types of deals that you would be doing to expand the platform?
We think about that. I always think in terms of the long-term secular growth trends of impacting our business. So I think it's important when you do M&A in an exchange, particularly someone like Cboe, is that you understand what those long-term secular trends are and that you do your acquisitions into that to sort of leverage up your platform and maybe diversify it a bit, but also stay true to your core strengths. So it has to make strategic and financial sense. It has to line up with the secular trends in the market, and it has to move the needle for Cboe. If we're going to do an acquisition, we want it to make a difference. We just don't want to do an acquisition that doesn't make a difference.
Fred, great to get some time with you. Thanks so much for joining us. Fred Tomczyk there of Cboe Global Markets, coming to us from the Hood Conference, the Hood Summit, I should say, in Miami. Let's get a check on the markets right now with Bloomberg's Abigail Doolittle. Abby, what do you see?
So we're seeing small gains for the S&P 500 up about 0.2%, but lots of outperformance for the stocks. So that chip index, of course, on those TMC results and hiking the view for 30% growth this year. Relative to the prior view of 20% growth. Investors really liking that, a big sigh of relief after the negative report and view from ASML. It seems as though chips and AI, that demand remains. The 10-year yield sort of reflecting the risk on sentiment, up about 0.8%. It could also have to do with the ECB, though, because, of course, that euro versus the dollar is down significantly, kind of gyrating its way into the dollar and yields here in the U.S. after the ECB cut rates for the third time this year to help out the economy. And then if we take a look at volatility, this is something that I've not been able to say for quite some time. Volatility is actually coming in. It is ebbing. Take a look at this VIX curve, and here are the various contracts for the VIX. In white, that's spot, 19.4. So it's still elevated relative to the complacent, let's say 12 or 13, but coming off of the highs. Now, the blue contract, that is the October contract that expired yesterday. That's the closest proxy for election volatility. It is above a 20, but you can see the rest of the curve coming in after that. It seems as though investors believe they have more certainty going into the election about who could win. Now, in terms of who could win either way, this is great work from our team member, Terrell Holt, and it shows the performance of stocks after both the 2016 and the 2020 election for various time periods. So you can see higher after 1 day, 1 week, 1 month, 1 quarter, and then 1 year after that 2020 election in particular, up more than 30%, and after the 2016 election, up, I should say, 30% and then 20%. The main message here, Sonali, is it looks like gains based on history could be ahead.
Right. Very interesting chart. Let's see how it looks this year. Depends on how long it takes to get that vote certified. Bloomberg's Abigail Doolittle, we thank you so very much for always looking under the hood. Now, coming up, a story about finding money to solve global issues. RockCreek CEO discusses the World Bank's role in emerging markets. That's next. This is Bloomberg.
All right, it's time for our daily Wall Street Week conversation. And does the World Bank have the capital to continue funding projects in developing markets? David Weston speaks with the CEO of RockCreek about the lender's creation and evolution over the decades.
As you know, about 80 years ago, when the Bretton Woods meeting took place, there was this important emphasis on helping to restructure and recreate the destruction that was done after World War II. And there was this emphasis on how do we go forward. So a number of multilaterals were created then, and since then, many more have come into existence all over the world. And their job was really to take capital that was generated from governments and turn that into a leveraged form of capital to give that out to different entities. The various institutions have morphed a lot. So, for example, the World Bank was created to help with the reconstruction of Japan and Europe, and now it's been working for many, many years on helping emerging markets and developing countries, which covers a lot of very different countries with very different economic structures and systems and income levels. EBRD, for example, was created to help Europe and Eastern Europe as it was changing its political form, and now is starting to do a lot more in Africa and other parts of the world. So all of these institutions have morphed, but the main thing has always been using public sector money to help grow the economies and structure new forms of financing to help development in different countries.
You served at the World Bank. Yes. When we talk about development, capital for development in emerging markets, that is vast. Yes. How big is that need? How do you even figure out how big the need is?
So you've seen all these big meetings talking about billions to trillions. Obviously, emerging markets cover all the way from China, which is a huge economy, to small countries like Peru or Sierra Leone. So vast spans with very, very different economics, populations, education levels, culture, etc. So what you mean by development is really bringing education, health, other social sector development needs to these countries, but also helping build their bridges, their dams, their clean energy infrastructure, and communications, and also their financial system. So, for example, helping to develop fintech in Latin America. So it's a very big range of things that the development institutions work with.
And that was the CEO of RockCreek speaking with David Weston. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
President Biden is en route to Germany as the turmoil in the Middle East escalates. Israel says an operation in Gaza may have killed the Hamas leader Yahya Sinwar. Bloomberg hasn't gotten official confirmation yet, but we want to get over to David Gura, host of Bloomberg's The Big Take podcast, to talk about the significance of this. We know there's not a lot of movement in assets, crude, for example, but I'm not sure that this is something that would necessarily move markets. Still, a huge step for Israel in the war, if true.
A huge step, and certainly the target that the Israelis wanted to take out after this happened on October the 7th. And so we know that Sinwar has been reportedly in tunnels beneath Gaza since all of this began. I think that it could be a kind of pivotal moment in the course of this war if he were to be taken out or killed, just because of the fact that he was the mastermind behind the October 7th operation.
What changes now?
That's a great question, and we've seen the pressure that the U.S. and other allies have been exerting on Israel to scale back some of their operations militarily, certainly as they think through how they might retaliate against Iran, what they might target, and what that might look like. Look, this is a very tricky time for the U.S. as we approach the presidential election, how much influence the U.S. has over Israeli policy. We saw with the attack that Israel made on Lebanon, them kind of going against what the U.S. hoped that Israel would do. So I think what remains to be seen here is just sort of the degree to which the U.S. has any kind of influence over the military strategy of Israel, certainly going into November and that presidential election.
And let's, of course, wrap this conversation into the fact that we are 19 days away from the presidential election. We saw Kamala Harris last night on Fox News. Of course, she's faced a lot of criticism over the fact that she's been appearing with friendly media, shifting the narrative, of course, going on Fox. I mean, what has the reaction been to her performance?
It's funny how that criticism has evolved, because before that bout of interviews that she did with friendly media, there was criticism that she hadn't done any. So this was a significant move that she went on to Fox News. She hadn't gone on before. Her running mate has appeared on Fox News Sunday for a couple of weeks now in a row. Look, I think that the Harris campaign believes that there is this kind of sliver of the electorate that's undecided, maybe Republican-leaning, might find Donald Trump distasteful and might want to hear from her. I think that that was the calculation that they're making, that their exposure to Kamala Harris thus far has been through sound bites filtered through Fox News. To hear her in that kind of forum for longer than 20 minutes might persuade some voters to come over to her side. See how effective that was.
It was an aggressive interview. I mean, Bret Baier interrupted her several times. He talked over her most of the time. He cut her off quite a bit. He didn't get her to answer the question as to why the Biden administration let in so many immigrants who came across the border illegally, and then rather than detaining them, as the Trump policy had been, set them loose. Do we know, have we heard from the Biden administration why they, for so many years, the first 3 years of the presidency, allowed so many, millions of immigrants in the country illegally?
We haven't got a huge amount of clarity on that point, but we know that that policy that the Biden administration put in place was held up in the courts for a long time. And it's certainly something, as you say, she was asked about directly over and over again by Bret Baier, and she pivoted as often as she could to talk about how this piece of legislation died on Capitol Hill.
But that's a
She's
recent
looking for
piece of,
solutions. A recent piece of legislation. So no, to answer your question, she hasn't fully explained why that policy was changed, aside from there being sort of humanitarian reasons for it back then.
David, how would you think that this interview actually went? Because to the extent that she was trying to gain defectors from the GOP to really support her, and to the extent that this was supposed to be a projection of strength, right, to take tough questions, did she succeed by any measure?
I think that she did in that regard. She kind of held her own, comported herself well in that interview. There was a piece by Michael Greenbaum in the New York Times today sort of looking at this is kind of a proxy for a debate. Fox News wanted to have a debate between these two candidates. Didn't come to fruition, isn't going to come to fruition. And I think there's a sense that Bret Baier was kind of playing that role, kind of raising a lot of talking points and policy positions that Donald Trump would have raised in the course of that debate, immigration chief among them. I mean, this is what a lot of voters care about. It's the economy, it's immigration. And you look at the length of the interview yesterday, more than half of it centered on immigration. So it's something that I think certainly viewers of Fox News, certainly a lot of Republicans, certainly a lot of supporters of Donald Trump wanted to hear Kamala Harris on the record on. Yeah, I think she comported herself well in that forum as a result.
All right, David Gura, always great to speak with you. That, of course, is Bloomberg's David Gura. You can follow David's coverage of the race and other Bloomberg stories on the Big Take Daily Podcast. And, of course, you can find the latest coverage on the U.S. election on ELEC Go on your Bloomberg terminal. Meanwhile, let's get a check on markets right now, because you're seeing the S&P 500 give up some of its gains. The S&P 500 still higher to the tune of about 1 to 0.2%. It's the same story if you take a look at the NASDAQ 100. A real push and pull going on, because you have NVIDIA shares higher by about 2.5%, but on the downside, you have Alphabet down by about 1%. So you can see that going on right now. Meanwhile, the bond market yields higher about 7-8 basis points. Of course, we got hotter than expected retail numbers this morning, and that's what's going on with that 10-year yield. We should talk about Netflix a little bit, because we are getting into the thick of earnings season. Netflix reports after the bell, and this stock has had such a great run. I mean, it's up 42% year to date. Of course, it's going to make the bears circle. And one of the concerns out there is that it's past the peak on sales growth.
It's been defying a lot of gravity here, because it has been shaking off every worry about subscriptions, about pricing. And really, I'm very interested to see in what they have to say about their new initiatives and whether they're actually going to make any money from it after all they've spent.
Yeah, I thought it was an interesting comment. I think it was off camera yesterday from Bailey Lipschultz. That, after a stock doubles or triples, Netflix from the low in 2022 has more than quadrupled.
340%.
It is fair to see it give up some gains, and it has certainly for the past couple of trading sessions, and it may tomorrow if they don't knock the cover off the ball. This is what price for perfection looks like.
All right, speaking of tomorrow on Open Interest, we'll be interviewing the CEO of JCPenney. This is Bloomberg.